What if just $100 invested today could grow into thousands of dollars in the future? Chart increasing. Most people think investing requires thousands of dollars. But in reality, many successful investors started with far less. With the right strategy, even a small amount like $100 can be the first step toward building long-term wealth. Investing in the United States has never been easier. Thanks to modern investing apps, anyone can start buying stocks, ETFs, and other assets with just a small amount of money. In this video, you'll learn exactly how beginners can start investing with only $100. The steps are simple, beginner-friendly, and designed to help new investors avoid common mistakes. Stay until the end because the final tips can help protect your money and increase your chances of growing that first $100 into something much bigger. Money bag. Section 1. Understand why investing matters. Before putting money into any investment, it's important to understand why investing is so powerful. Money sitting in a bank account often grows very slowly. In some cases, inflation can actually reduce its value over time. Investing allows money to grow through compound growth. For example, if $100 grows at an average annual return of 10%, that money keeps earning returns year after year. Visual cue: show compounding chart growing from $100 to larger amounts. Over time, small investments can turn into significant wealth simply by allowing the money to grow consistently. The first practical step is choosing a beginner-friendly investment platform. Many investing apps in the United States allow users to start with very small amounts. Some platforms allow fractional shares, meaning investors can buy a portion of a stock instead of the full price. For example, if a stock costs $400, a person can still invest $20 or $50 into it. Visual cue: show phone screen purchasing fractional shares. Look for platforms that offer low or zero commission trading, easy-to-use mobile apps, fractional share investing, educational resources for beginners. Choosing the right platform makes investing much easier and less intimidating. One of the safest ways for beginners to start investing is through ETFs, also known as exchange-traded funds. An ETF is a collection of many stocks combined into one investment. Instead of buying a single company, investors can buy a fund that contains hundreds of companies. Visual cue: show basket of company logos representing diversification. This reduces risk because the investment is spread across many businesses. Some ETFs track large parts of the stock market. This allows beginners to invest in the overall market rather than guessing which individual stock will perform best. Even with only $100, diversification is possible. Instead of putting all the money into one asset, investors can divide it across multiple investments. For example, $50 in a broad market ETF, $30 in a technology ETF, $20 in a dividend-paying stock. Visual cue: pie chart splitting $100 into different investments. This strategy spreads risk and allows exposure to different sectors of the market. Many beginners make the mistake of trying to get rich quickly in the stock market. But successful investors focus on long-term growth instead of short-term trading. Markets go up and down every day. That volatility is normal. Visual cue: show stock chart fluctuating but trending upward long-term. Historically, long-term investors who stay invested for years often benefit from overall market growth. The key is patience and consistency. The first $100 is only the beginning. Wealth builds faster when investments are made regularly. For example, $100 invested today. Another $100 next month. Continued investing every month. Visual cue: calendar showing recurring monthly investments. Over time, consistent investing combined with compound growth can create powerful financial results. Some investments pay dividends, which are payments companies distribute to shareholders. Instead of withdrawing those payments, many investors choose to reinvest them. Reinvesting dividends allows those payments to purchase additional shares. Visual cue: dividends automatically buying more shares. This accelerates compounding and helps portfolios grow faster over time. CTA, here are a few important tips every beginner investor should remember. First, never invest money that may be needed immediately. The stock market works best for long-term investments. Second, avoid chasing hype or trends. Many viral investment opportunities carry high risk. Visual cue, show warning sign over risky investments. Third, focus on learning continuously. The more knowledge gained about investing, the more confident decisions become. And finally, remember that every successful investor started somewhere. Even the biggest portfolios began with a small first investment. That first $100 could be the beginning of a long-term journey toward financial growth and independence. And once that first investment is made, something interesting begins to happen. The mindset around money starts to change. Instead of asking, "How can money be spent?" the question becomes, "How can money grow?" Visual cue, shows small plant growing into a large money tree seedling money bag. That shift in thinking is what separates savers from investors. Because every dollar invested becomes a worker that earns more dollars. Imagine each dollar acting like a tiny employee. One employee becomes two. Two become four. Four become 10. Over time, those employees keep working day and night in the market. Visual cue, animated workers turning into dollar bills building a stack. Now imagine continuing the same strategy year after year. Invest $100 today. Add another $100 next month. Keep repeating the process. Even if the amount seems small, consistency creates powerful results. Visual cue, calendar pages flipping while investment balance grows. Many investors underestimate how powerful time in the market really is. For example, if investments grow at an average rate of around 8 to 10% annually, money can double multiple times over decades. This is why people who start early often have a huge advantage. Visual cue, timeline showing growth from $100 to thousands. But here is something even more important. Investing is not about predicting the perfect moment to buy. Trying to time the market often leads to missed opportunities. Instead, successful investors focus on staying invested consistently. Markets may drop sometimes. Prices may fluctuate. But historically, markets have shown a long-term upward trend. Visual cue, stock chart dipping temporarily then rising higher. That's why patience is one of the most valuable investing skills. Another powerful habit is continuing to learn about money and investing. Financial knowledge compounds just like investments do. The more someone understands the market, the easier it becomes to spot opportunities and avoid costly mistakes. Visual cue, books and charts appearing around investor. And the truth is, building wealth rarely happens overnight. It happens slowly at first. Small investments. Small gains. Steady progress. But eventually those small steps start to accelerate. What once looked like a tiny investment account begins to grow faster and faster. Visual cue, investment graphs suddenly rising faster over time, chart increasing. And that's when many people realize something powerful. Starting with just $100 was never about the amount of money. It was about building the habit of investing. Because once the habit is built, increasing the investment becomes easier over time. The journey toward financial freedom often begins with a single decision. The decision to start investing today instead of waiting for the perfect moment. And that small $100 investment might one day become the foundation of something much bigger, and this is where the real opportunity begins. Most people spend years waiting for the right time to start investing. They believe they need thousands of dollars. They believe they need perfect knowledge of the market. But the truth is much simpler. The most important step in investing is starting. Visual cue, finger pressing the invest button on a mobile phone. Because once that first investment is made, the journey toward building wealth officially begins. Over time, knowledge grows. Confidence grows. And the investment portfolio begins to grow as well. Small investments slowly turn into larger ones. Visual cue, small stack of coins slowly turning into large stacks of cash money bag. And that first $100 may eventually become $1,000, $10,000, or even much more over the years. Not because of luck, but because of patience, consistency, and smart investing habits. The stock market rewards people who stay disciplined and think long-term. Visual cue, long-term stock chart rising steadily, chart increasing. So whether someone is just starting their financial journey or looking to build better money habits, the key is simple. Start small. Stay consistent. Keep learning. Because every successful investor started exactly the same way. With a small first investment and a long-term vision for the future. And remember, building wealth is not about how much money someone starts with. It's about how early they start and how long they stay invested, because the next investment opportunity could be the one that changes your financial future.